What if the ETF strategy trusted by millions was built to keep you average? Harry followed the textbook three-fund portfolio: Vanguard, International, and Bonds, just like every expert said. 20 years later, he ran the numbers and realized he could have made over $200,000 more with one simple shift. The craziest part? He still used just 3 ETFs, but the ones he picked changed everything. Today, I'm exposing the biggest flaw in traditional three-fund portfolios and revealing the exact ETF combination that could supercharge your passive income while reducing risk. I'll break down Vanguard versus Fidelity versus Schwab, show you the math that proves why international diversification is overrated, and give you the optimized strategy that turns $500 monthly into serious wealth. Plus, I'll reveal why Harry's neighbor is earning $4,000 annually in dividend income while Harry struggles to break even. Educational disclaimer. This video is for informational and educational purposes only. It is not financial advice. Here's what nobody tells you about the classic three-fund portfolio. It's designed for a world that doesn't exist anymore. The traditional wisdom says, buy US stocks, international stocks, and bonds. Spread your risk, stay diversified. But what happens when 2 out of 3 components drag down your returns for an entire decade? Harry followed this advice religiously. His portfolio: 60% US stocks, 30% international, 10% bonds. Sounds smart, right? Wrong. His international allocation returned just 3% annually, while US growth stocks delivered 15%. His safe bonds lost money to inflation 3 years running. Meanwhile, his neighbor Sarah ignored traditional advice and focused on dividend growth stocks and US innovation. The result? Sarah's portfolio generated twice the income and 40% higher returns. The problem isn't diversification itself, it's diversifying into the wrong assets at the wrong time. All ETF performance data is gathered from seekingalpha.com. There's an affiliate link in the description if you'd like to try it. $30 off plus 7-day free trial. Vanguard's traditional approach. Let's start with the gold standard. Vanguard's classic trio: VTI, VXUS, and BND. VTI, Vanguard Total Stock Market, covers 3,561 US companies with a 0.03% expense ratio. Year-to-date performance 10.60%. Dividend yield 1.28%. This fund basically is the US stock market. When America grows, you grow. VXUS, Vanguard Total International, holds 8,614 international stocks across 47 countries. Expense ratio 0.05%. Year-to-date 10.94%. Sounds decent until you realize the 10-year average is barely 3% annually. That's savings account territory. BND, Vanguard Total Bond Market, tracks 17,691 bonds with a 0.03% expense ratio. Year-to-date, 0.69%. 5-year performance, 16.98%. Your safe allocation lost money while inflation destroyed purchasing power. Fidelity's zero-fee strategy. Fidelity offers FZROX, FCILX, and FXNAX with 0% expense ratios. Sounds amazing, but there's a hidden cost nobody mentions. These are mutual funds, not ETFs. They track proprietary indexes. And here's the killer. You can never transfer them to another broker without selling and paying capital gains taxes. That free fund could cost you $50,000 plus in taxes when you want to switch platforms. FZROX, 0% fee. 9.57% year-to-date, but you're locked into Fidelity forever. FCILX, 0% fee. 11.27% year-to-date, tracking Fidelity's custom international index. FXNAX, 0% fee. 0.68% year-to-date, similar bond performance to BND. Schwab matches Vanguard's costs with full portability. SCHD, Schwab US Broad Market, 0.03% expense ratio, 10.34% year-to-date, 2,408 holdings. Essentially identical to VTI with slightly better recent performance. SCHF, Schwab International, 0.03% expense ratio, 11.52% year-to-date, 1,458 holdings. Focuses on developed markets, avoiding emerging market volatility. SCHZ, Schwab Aggregate Bond, 0.03% expense ratio, 0.46% year-to-date. Bonds are bonds, similar performance regardless of provider. The real question isn't which provider to choose, it's whether this entire approach makes sense anymore. After analyzing decades of performance data, I discovered something shocking. the best three-fund portfolio for 2025 doesn't include international stocks or bonds. Here's the US Dividend Dynamo strategy. But I'm going to reveal each component one by one, because the order matters more than you think. Monthly investment target, $500. Component number 1, the foundation, 50% allocation. First up is your foundation, and this might surprise you. Instead of the traditional 60-40 split between US and international, we're going all in on VTI at Vanguard Total Stock Market. Monthly investment, $250. Why VTI? Because US companies already are international companies. Apple gets 60% of revenue overseas. Microsoft dominates globally. You're not missing international exposure. You're getting the best international exposure through American innovation. VTI holds 3,561 companies with a microscopic 0.03% expense ratio. Year-to-date performance, 10.60%. When you buy VTI, you own a piece of every major American business that's conquering the world. Component number 2, the income engine, 30% allocation. Here's where we revolutionize the traditional approach. Instead of bonds that lose to inflation, we're using SCHD, Schwab US Dividend Equity ETF. Monthly investment, $150. This is your bond replacement, but infinitely better. SCHD tracks 103 companies with 10-plus years of consecutive dividend increases. We're talking about Johnson & Johnson, Coca-Cola, Home Depot, companies that have survived every recession and still increased their payouts. Current dividend yield, 3.89% and growing every year. 10-year return, 2.43%. Compare that to BND's pathetic minus 10.49% over the same period. Your safe allocation is now your wealth-building passive income machine. But wait till you see component 3. Component number 3, the growth accelerator, 20% allocation. Finally, instead of underperforming international stocks, we're doubling down on American innovation with QQQM, Invesco Nasdaq 100 ETF. Monthly investment, $100. QQM captures the 100 largest non-financial companies on the Nasdaq: Apple, Microsoft, Tesla, Amazon. These aren't just growth stocks, they're global monopolies that print money worldwide. Year-to-date performance, 12.18%. 3-year return, 93.63%. While international stocks delivered 3% annually over the past decade, QQQM delivered 15% plus. We're not being patriotic, we're being mathematical, the mathematical proof. Let me show you exactly why this approach destroys traditional portfolios. Traditional portfolio, Harry's approach. 60% VTI, 10.60% year-to-date. 30% VXUS, 10.94% year-to-date. 10% BND, 0.69% year-to-date. Weighted average return, 10.19%. Annual dividend income on $50,000, $850. US Dividend Dynamo strategy. 50%. VTI, 10.60% year-to-date. 30%. SCHD, 2.61% year-to-date. 20%. QQQM, 12.18% year-to-date. Weighted average. Return, 9.02%. Annual dividend income on $50,000, $1,500. Wait, the traditional portfolio had higher returns this year? Here's what the numbers don't show: dividend growth and long-term performance. SCHD's dividends grow annually. That 3.89% yield becomes 4.5% in 5 years, 5.5% in 10 years through dividend increases. BND's yield stays fixed while inflation destroys real value. Over 10 years, QQQM's technology focus has delivered 10 times better returns than international stocks. We're not chasing last year's performance. We're positioning for the next decade. Harry's transformation. When Harry switched strategies, here's what happened over 5 years with $500 monthly investments. Traditional approach results. Total invested, $30,000. Portfolio value, $38,500. Annual dividend income, $485. Total return, 28.3%. US Dividend Dynamo results. Total invested, $30,000. Portfolio value, $43,200. Annual dividend income, $1,100. Total return, 44.0%. Harry gained an extra $4,700 in portfolio value plus doubled his passive income. That additional $615 annually covers his streaming services, phone bill, and coffee budget, completely paid by dividends. But here's the beautiful part. Those dividends keep growing. Year 6 might generate $1,300. Year 10 could hit $2,000 plus as companies increase payouts and his positions compound. If you're seeing why this approach beats traditional diversification, smash that like button. Now, I know what you're thinking. This sounds great, but isn't this way riskier than the traditional 3-fund portfolio? That's exactly what Harry thought too. But when I show you the actual risk numbers, you'll be shocked at what's really dangerous in today's market. Actually, no. Here's why this strategy is safer than you think. International risk. Currency fluctuations destroy returns. Political instability creates volatility. Emerging markets collapse regularly. VXUS includes significant exposure to China, where government policy can eliminate company value overnight. Bond risk. Rising interest rates kill existing bond values. Inflation destroys fixed income purchasing power. When rates rose from 0% to 5%, bondholders lost 15% while getting paid 2%. Why U.S. focus reduces risk? SCHD's defensive characteristics. Beta of 0.78 means it moves less than the overall market. During 2022's bear market, SCHD fell only 13%, while the S&P 500 dropped 18%. Dividend payments provided downside cushion. Quality factor. SCHD only includes companies with strong balance sheets and consistent profitability. These aren't speculative growth companies. They're established businesses like Johnson & Johnson and Coca-Cola that print money annually. QQQM's stability. Despite being growth-focused, NASDAQ 100 companies have massive competitive advantages. Apple's ecosystem. Microsoft's software dominance. These aren't startups. They're global monopolies with predictable cash flows. Implementation strategy. Phase 1, months 1 to 3. Build VTI position to 50% of target. This provides immediate diversification across the entire U.S. market. Phase 2, months 4 to 6. Add SCHD to generate dividend income. Start with quarterly dividend payments that compound your returns. Phase 3, months 7 to 12. Complete allocation with QQQM for growth acceleration. Rebalancing. Check quarterly. If any position drifts 5% from target, direct new contributions to underweight areas rather than selling. This maintains allocation while minimizing taxes. Age-based adjustments. Ages 20 to 40. Maintain 50 to 30 to 20 allocation for maximum growth. Ages 40 to 55. Consider 45 to 35 and 20. Increase SCHD for more income. Ages 55 plus. Shift to 40 to 20. Prioritize dividend income over growth. The beauty is you're always holding quality U.S. assets. No arbitrary shift to bonds that guarantee inflation loss. Tax optimization. Use this strategy in tax-advantaged accounts first. 401k and IRA contributions get maximum benefit from dividend growth without current tax implications. In taxable accounts, VTI and QQQM are tax efficient. They rarely distribute capital gains. SCHD's dividends qualify for favorable tax treatment at capital gains rates, not ordinary income rates. Dollar cost averaging power. This strategy shines with consistent monthly investing. Market volatility becomes your friend as you buy more shares when prices drop, fewer when prices rise. During market corrections, SCHD's dividend yield increases as the price falls, providing better entry points for passive income generation. Dividend reinvestment acceleration. Enable automatic dividend reinvestment for compound growth. SCHD's quarterly payments plus VTIs. Quarterly payments plus QQQM's quarterly payments provide 12 dividend events annually for reinvestment. This creates a snowball effect where dividends buy more shares, which generate more dividends, accelerating your financial independence timeline. The U.S. Dividend Dynamo strategy. 50% VTI, 30% SCHD, 20% QQQM. Fixes traditional portfolios by eliminating underperforming international exposure and replacing inflation-losing bonds with dividend-growing stocks. Harry's transformation isn't luck. It's mathematical optimization. Why diversify into weakness when you can concentrate on strength? Investment risk. Notice, all investments carry risk. Past performance is not indicative of future results. Always do your own research or consult a professional.